We have Richard Wilson here from the Family Office Club. We are going to talk all things family offices, a little bit of alternative investments, breaking into family offices if you're a sponsor, all the above. Thanks for joining us, Richard.
Yeah, appreciate you having me here, Brad.
I'd love to hear more about where you guys are going and how you think about your business today and the future of family offices.
Yeah, I think that with AI, you can fake anything and everything that's not in person. So we're hosting 30 in-person events next year, and we're looking just to ramp up our in-person events. You're 16 times more likely to close a deal if you meet somebody in person or take them to your asset. So we really emphasize that. We also see using artificial intelligence tools that are pre-trained and programmed for deal makers, for due diligence, for structuring deals, for negotiating fees. All of that is super critical. Generic AI tools are fed by Wikipedia posts and Reddit posts. So that's one area we see the future in. And then we're really just working with a lot of decamillionaires, centimillionaires, and billionaires. And the more we can interview them on stage about their exit, about how they created their wealth, how they manage their wealth, it's really just super founders and super entrepreneurs have figured out how to make a lot of money or have sold their business is basically what the whole community is around.
Yeah, and it's such an opaque industry. Hard to know what best practices are or what other family offices are doing if you are not out there talking to them. It's not like there's this one go-to source for all family
Right.
offices.
Yeah, for sure. And I think that just the more you're around people who are worth tens of millions of dollars, probably the better your business life is going to go. And so I think just absorbing kind of like mental models through osmosis and just building that network in a natural way is important.
Yeah, and it's amazing the generosity of a lot of these people in sharing deal flow, sharing vendors. I've been impressed with that.
For sure. Usually, like people who are ultra wealthy usually have employed a lot of people, created a lot of wealth for other people along the way. And sometimes that gets forgotten in a journalist headline that just focuses maybe on negative things. So I always say that our events are kind of like an antidote for reading general news media of this thing's on fire, this thing blew up, look what this politician said. At our events, it's like, here's what I did to build my platform. Here's how I went public. Here's how I sold my company. Here's my 5 reasons I was able to scale to 100 million in revenue. And it's like very exciting, firing stuff.
Yeah, and that's why these groups like the Tiger 21s of the world, that's why these groups exist, is that, there are networking opportunities, and not only for education, but also for real leads on deals. And it's hard when you are kind of on an island. There's only so many of these family offices. And so when you're not interacting with your colleagues day to day, it can be challenging. So I can certainly see the value of these events. Now, you mentioned AI. So how do you view from the due diligence and operational standpoint of a family office? How do you see that interacting with AI and the future of that technology?
Yeah, basically it's like with AI, you can be more thorough, more systematic, and then go deeper on things that matter, but then protect your time really well. So I see it as basically having a second brain, and you can walk around the world and not use a skateboard and not use a bicycle and not use a car or an airplane. That's your choice. It's probably healthier if you only do that, but you'll move around the world slower. And if you only use a car and you never walk anywhere, you'll probably get out of shape. And that's probably unhealthy. Just like if you only use AI and you don't use your human brain, you'll probably get dumber. But I don't think anyone who's ambitious looks to do that. They're just looking to get from point A to point B faster. So when they get to point B, they can go really deep on the deals that matter, really deep with the investors that matter, and waste less time on clutter and fluff and things that are not high quality. So I just see if you get GPT for free, you're mentally impaired within your second brain because it has 105 IQ. If you pay $20 a month, 125 IQ. If you pay 200 a month, 135 IQ. And so you get to choose whether you have a second brain or just use your first one. And you get to choose whether your second brain is impaired or genius level. So to me, that's pretty interesting stuff.
But from a resource standpoint at these family offices, because a lot of them run pretty thin, how do you see it impacting operations?
Right. I see it as saving on the amount of headcount they need in their operations. So before you might have multiple staff members just helping with upfront due diligence on transactions. Now you might have one person doing the work of 2 or 3 that are more effective because they're able to go deep and be more systematic, more thorough. So that's the biggest change I'm seeing, is that people are terminating the employment of people that were doing upfront DD screening, but now they're going deeper with maybe an in-house accounting, forensic accounting expert, or maybe someone who flies and goes on site, or someone with really deep expertise. So each person on the team is maybe more expensive, but there's less people on the team, is kind of the trend
Yeah.
I'm seeing.
Yeah, it'll be interesting to see if the threshold on assets is reduced for the ability to have your own family office with
Right.
inclusion of AI. You would think. And I've worked for a family office, and we run a micro family office, so we kind of specialize in the 2 to maybe 20 million of assets before people are quite ready to start hiring a team. But it'll be interesting to see the people that really want to do it, or just passionate about investments, want to have control of their full operations, whether or not they end up dipping their toe in because they have these new tools.
Right. Yeah, for sure. I mean, I think that many people have a virtual family office where they basically outsource everything and just handle maybe one little thing in house. And so I think that'll just support that whole trend.
Yeah. And you're right on the diligence. That's for sure. I am starting to see questions come through that clearly have been through a deck that we've provided a client. And the questions will come back, and I'm like, oh, well, this is ChatGPT asking these questions, which is great. I think that's wonderful, because the reality is that when investors get these documents, I mean, they're exhaustive, especially if you're looking at an extreme amount of deal flow in the private markets. And nobody has time to read all of them unless they literally are just doing that as a full-time job. So I think it's great that these systems can filter some of the higher level questions and enable people to be a little bit more thoughtful about the docs.
A lot of investors just go off of trust. And if they know someone else who's invested and they've asked some basic questions, they may just invest. But it'd be in their best interest to have the fee structure, legal structure summarized. And then to, obviously, anyone listening, you should use a real attorney and use a real forensic accounting firm. And AI does not replace any of that at this point. It just helps de-risk your investment of time so that you choose who to spend expensive resources on more wisely, I find.
Yeah, no, 100%. And so what on the asset side, what interesting trends are you seeing, and from an allocation standpoint, from the family offices that you're speaking with? I imagine, is it more of the same? Is it more leading into private markets?
Yeah, I would say that there's a idea of being kind of risk on because of asset inflation and just runaway values and different trends that are going on, whether it's the value of Google or Tesla or Nvidia, or whether it's fear of government spending, the amount of debt we have. I think there's twice as much discussion going on about allocation to gold and Bitcoin than there was 4 to 5 years ago. I think there's a interest in Fidelity's housing of Bitcoin versus going with Coinbase or Gemini or crypto.com or something. People feel safer with a Fidelity. They feel safer in a BlackRock ETF, et cetera, than a cold storage key that they might lose. So that's a trend. Obviously, credit's been a trend for the last 2-3 years. So that's nothing new to our listeners. But I do think we're at the point now in the cycle where investors have been beat up a little bit, they've been bloodied a little bit. And because of that, they've had time to look around. Some of them are making more transactions right now and moving forward on deals to recapitalize manufacturing companies, to provide pref equity to real estate deals, et cetera, where there wasn't as much of that maybe 12 months ago. I think people were worried they were too early in the downturn, but I think now some investors are like pulling the trigger on some deals and helping recapitalize some platforms because they realize it's going to recover and interest rates will go back down at some point, and they don't want to miss all of that.
Yeah, no, I definitely agree with that. We're starting to see more and more activity, and people are like, oh, okay, it's game on again. The private credit, what about real estate credit? Are you seeing that as the appetite for real estate debt increase these days?
Yeah, we are for sure. I just think that investors are a lot more careful on construction financing, any type of variable rate debt, of course. And I feel like they need to meet in person more times and do more thorough due diligence. Look, there's a little bit of a flight to quality after many investors have lost a tooth or two in the last through 3 years. I mean, everyone's has equity at risk here, lost all their equity in here. Distributions are lower than expected. So the sentiment is not the most cheerful, optimistic, but everybody knows that you gain back by investing when others are fearful. If you only invest at the top of the market, then that is when you're going to get taken for more of a painful ride. And so I think the wisest investors are always trying to build their deal flow funnel And we always tell investors, like, you need to be able to see deals first exclusively and at a better valuation than anybody else. And if people are coming to you because you're a strategic investor, then for those deals where you're playing offense on your balance sheet, you're going to compound your wealth greatly. And the smartest investors I know put money in the stock market and diversify a bit, put a good amount of money into real estate. And a good amount of that is cash flowing real estate and some development. And then they play offense, a pure offensive game in auto dealerships or manufacturing, whatever the niche is where they're an entrepreneur and have created their wealth. But I think that different brains need to be managing that. The person who manages your wealth in the stock market is probably not going to help you select a self-storage sponsor in Texas that gets you allocated to that real estate food group and is going to help you invest in that self-storage fund or sponsor in Texas. And they're probably not the person managing your offensive game as an entrepreneur. It's probably yourself. And so a lot of families take years to figure that out through mistakes and then get it dialed in over time.
Well, I feel like I must have sent you a check because that's exactly the pitch that we make to a lot of
Okay.
healthy families. Because if you have somebody that's just used to managing stock and bonds, a 60-40 portfolio, who is now trying to advise you on private equity and real estate, that might be misguided. So, anyways, I'm a big believer and do this with my own personal wealth. I have experts for various strategies, right? So, yeah, no, that's great to hear from you.
I think the wealth management space is just so crazy commodified these days. So it's become a sales job for platforms, and it's hard to gain a book of business. I have real respect for someone who can sell a wealth management solution because it comes down to relationship, trust, and they really trust you and your insights. And there's people that add big value in the niche, but it's tough. It's so commoditized. So it's
Totally.
interesting to watch.
Yeah, it's interesting to see them pile into, or at least try to make an effort to go towards alternatives.
Yeah,
And it feels like part of that is because they're seeing fee compression. Maybe not going from 1% down to 75 basis point, but I think what they're seeing is they're having to add more services to get that same level of fee. And so you see them making a big push, at least all the major guys are making a push into alternatives because besides the benefits of it, I think that it's good for their business because it lowers volatility. But we'll see if that works out for them.
yeah.
Maybe on that front, are you seeing family offices make a shift or allocate more into more evergreen type of funds within private equity or real estate because of the drawdown nature of calling capital can be a little trickier from a planning standpoint
Right.
or no?
Right. We do see interest in that. I think that one of the tricky things is that some family offices want to invest in direct deals. Others want to invest into funds. Less funds out there have an evergreen fund model in the private market. Most funds are, we hold it for 4 to 5, 6, 7 years. We can extend it up to 10, maybe 12, deep on page 95 of the PPM that might say
Yeah.
that. I would say probably less than 5% of funds that get shown to me are evergreen in structure. But I am the type where I'm kind of a low leverage cash flow, build momentum, build something up to get it huge type mindset versus a buy, flip it quick or a short term mindset. You can't always control what the macro environment's going to do or what Trump's going to say.
You probably built your
Yeah.
business like one brick at a time, right? So it's natural that you want to invest that way too.
Yeah, for sure. I think that in the future, there'll be 5 or 10 times more evergreen things out there in the market than there is now. Or so I'm not paid to say any of this, but I just feel like I like Warren Buffett's mindset and approach of like anything new I take on should be better than the quality of cash flow that I'm getting right now, and to do things within your circle of competence that you're confident will be great long term, whether or not the market says short term they're slightly overvalued or undervalued. If you can force appreciation and it's valuable long term, then you should acquire that strategic asset. And that's just how we've built our business the last 18 years.
And great. And speaking of that, we have a fair amount of sponsors who check in with us and listen to the podcast that are trying to grow as well. And so it'd be great to kind of hear how not only you've built your business to get in touch with all of these family offices and become such a resource for them, but also to hear how kind of emerging managers and sponsors that typically deal with retail can access the family office channel.
Yeah, sure. Get here. We've done about 50 little acquisitions and organic growth of digital assets and other investor clubs. So we have about 17.9 million social media group members. LinkedIn, we have 15.5 million people in our LinkedIn groups. And in 1 month this year, we had 30,000 posts in those groups. They got 100 million views. And so just a ton of a ton of like opportunity, investors, sponsors, fund managers. The one thing it's taught us is what it's like to be a very big multi-billion-dollar family office, because we have this brand, Family Office Club and familyoffices.com. And I'm not Mark Cuban, far from that. But the billionaire or centimillionaire who gets a lot of deal flow, we can definitely relate to that now. One thing we teach at our events is when you communicate with investors, the more high quality the investor, the more concise you need to be. So you need to have a one-liner, 1-minute pitch video, one pager, short, concise pitch deck, get right to the point, say things that nobody else is saying. And when you message somebody, your message should be the most valuable message that any human being on planet Earth has sent them that day. And it's offering them a deal structure or a resource or something that's in their best interest to reply. Because most people just send out a pitch and it's not concise and it sounds like everyone else. And they have some Greek god capital brand name that nobody knows what it means.
What challenges do you see within the family office space right now? What are people what's keeping them up at night?
One challenge in the space that just exists is there are ultra wealthy families that don't know what a family office is. And they basically are a family office. They just don't know what a family office is. The other challenge is that some people will call themselves a family office, but they're kind of more of a fund to fund or just an investment fund. They're kind of misunderstanding what the concept is. So that's a challenge in the space in general, but it's growing a lot. The family office space manages more capital than all of venture capital and private equity combined. There's about 14 trillion in the family office space. So it's massive. Challenges that family offices face is figuring out who to trust for software. A lot of family offices use software packages such as Addepar, but a lot of software is priced based on your AUM. And a lot of families just feel in general when they're trying to figure out who to trust for life insurance or who to trust for this or that service, the most knowledgeable experts are also the people selling them the biggest life insurance policy possible. And so that kind of comes with the territory of the finance industry, but it's tough for family offices to know who to trust, what's just a sales pitch, where's the true quality there. And I think the other thing, a lot of family offices are smart enough to know things such as, okay, there are momentum plays going on. It's almost like an artificial economy because the US government is pumping this or pushing that. And they don't want to miss out on these wild swings in tech, AI, robotic. They also know that when NVIDIA makes up X percent of NASDAQ or S&P 500 or all of US pension fund wealth, there's some danger there and to be careful. And I think that is a challenge to the space is how do we be smart about these trends, but they're not experts on calling the top. And sometimes they would rather be de-risked and just have a little bit of allocation to it and not care if they miss out on some of that because they're already wealthy. They're not trying to become wealthy. They're trying to make sure they stay wealthy while still growing their wealth at a good clip, beat inflation, basically.
Indeed, that's kind of what we preach. And we also preach, after tax returns. So thinking about tax strategy. So I imagine that's big in your world. And so maybe touch on
Yep.
that and what's top of mind for people on a after tax standpoint.
Yeah, sure. I think a lot of investors I know have gotten beaten up on conservation easements that were syndicated in recent years. Some of that was a threat of getting beaten up and it hasn't fully resolved yet. Now there's IRS changes going on. We'll see what happens. But that area has gotten a little damaged reputationally. There's some family office interest in captive insurance policies, which I think used to be more under scrutiny and now are a little bit less. And obviously just plain vanilla becoming a real estate investment professional in the eyes of the IRS and having bonus depreciation and cost seg type stuff. That's thought of right down the fairway of not super risky tax planning that a lot of families like to leverage the depreciation of assets, whether it's real estate or equipment on a food truck or dental equipment or whatnot. So that's probably the most common that just comes up all the time.
Sure. Yeah, we're seeing a lot of that given the new bonus depreciation. 100% is back, of course. All right. What else is kind of interesting in the family office space that you think is worthy of chatting about here?
Yeah, I mean, I think that the one thing that's interesting is that the wealthiest people at our events aren't always the flashiest. They may not go around bragging a lot about having this, that, or the other. Because when you have people just approaching you nonstop and your calendar is way too full and everyone wants a piece of you and wants you on their calendar and wants to meet to catch up on something, but it's to pitch you something, there's not a huge desire to look like the flashiest person in the room. And a lot of people who are very successful are pretty humble about it. And they might say, oh, I'm in the car wash business, but they don't say I just sold my 50 car washes to JP
Yeah.
Morgan. So I think that's one thing that's just really interesting. And then the other thing is just that doing custom deal structures and not just setting up your family office custom to you, but when you're negotiating a transaction, knowing how to negotiate different share classes in a corporation or different types of membership interests in an LLC, and using gross revenue royalties or pref equity or different types of waterfalls or hurdles or an equity warrant versus equity in a project. I think all those things are just so critical and nuanced. So any sponsor or fund manager or investor listening, if you haven't spent dozens of hours of your life going really deep on deal structures and you haven't closed 50 or 100 transactions yourself where you negotiated the structure line by line, I think that rabbit hole goes super deep. And I find that it takes investors at least 4 to 7 years after having a big exit just to get the basics of deal structuring in their mind. Most people will do due diligence, ask what the fees are, ask if there's any negotiation room there, and then just invest. And then investors may get better at negotiating fees, but many of the bigger investors I know just don't realize they could custom structure the deal if they're the biggest check in the deal, or create their own new share class and fund half the deal. So that a lot of the value we try to add to families and our members is just teaching that at our workshops. And then also helping negotiate the structure may be way more important than what fee you're paying, and just turning investors' lights on that it's a whole other channel to think through besides where you're going to invest, what you're going to invest in, quality of the team. The fees may matter the least because if you have the right team and the right structure, I mean, who cares if the team gets paid really well? They should, as long as they're just not getting paid really well the day you close before they add value. The whole idea of deal structure is so fascinating to me. There's no role out there in our industry where someone is literally called, oh, I'm the deal structure strategist. Do you have an attorney? And you have people that originate deals, but just on deal structure, you could spend your whole life just on that, I feel like, after doing this for a while.
Totally. And there's no, there's no formula. Sure,
Yeah.
it's a whiteboard. It's blank space. If you come in and with enough capital, and the only way that deal's getting done is if you're writing the check, you have an incredible amount of power. And yeah, and we tend to help people out more on the front end when they're getting those fee discounts because they're not writing the $20 million check, they're writing the $1 million check. But there is a point where you do graduate to exactly what you're talking about, where you all of a sudden are negotiating or setting the terms.
For platforms that are listening or sponsors or people raising capital, you have the power of all those investors behind you. So if you are the one gathering up the checks and bringing in 3, 5, $10 million, and you go to an asset owner, you could use a deal structure that allows them to carry 10, 15% equity to your next sale. Or you could allow them to be some sort of pref equity investor in the deal you're doing and negotiate that. And if you show investors, hey, most people do deals like this. This is the amazing deal structure we got here. It's interest only with a balloon payment in 5 years, and we have seller financing. It's almost impossible for us to get foreclosed on, and the rate's better than a bank. The investor will lean forward and say, hey, that was smart. I mean, I haven't negotiated a deal like that. So now I see the value just in your deal structure smarts and maybe allocating to you. And I think that can help people listening who are raising capital raise capital twice as fast. And everyone thinks they have an investor lead gen problem. But if their deal flow is amazing and their structure was out of this world, the investors would probably come in twice as fast.
That is 100% true. There's a subset of guys and girls that really appreciate that and really respond to that structure. Whenever we start negotiating deals where maybe some of the GP fees get, subordinated and get put back into the LP structure, overwhelmingly people get excited about that because it's something they're just not used to seeing. And so that's very good advice for trying to raise capital, making it differentiated versus just another deck on multifamily value add deal that everybody's seeing every day in their
Right.
inbox.
Yep.
So that's great. Last question is a detailed one about if a family decides that they are ready for this family office stage of their life. They've had this giant exit. They're at 50 million or above. If you had to start them over or start them fresh, who's the first hire? Who's the second? How would you kind of lay that out over a few years?
Right. I think the most important thing is to reflect on what life you want going forward. Because if all you want to do is sit on a beach and play golf, that's one thing. If all you want to do is have passive income and then have 5 million to play around with new ideas and whatever industry you're in, dentistry or whatever you want to do, that's a different reality. If you love real estate and you love construction, but you also still own some of your auto dealerships or stem cell centers, whatever it is, then that's also a different reality. And so the thing that I see as a mistake is people rushing into formalizing the family office when they don't know what they want their life to look like. They haven't defined their values as a family and their goals and what they want their ideal day to look like. And if you don't know your own values, how do you hire someone in line with your values? And so I would start with mapping out your values, your goals, your ideal life going forward, where you're going to live, et cetera. And then look at the three parts of your portfolio: wealth management, who's the 1 to 3 people, put me in the public markets; real estate, what food groups of real estate do I want to be in and what states and why, and at least have a thesis on that maybe. And then where you're going to play offense if you do want to still play offense in business and really grow your wealth, because no one hires a wealth manager to 10x your wealth. So I think that that's the most important thing. And then typically, once you have that in place, it's hiring a strong kind of CFO or controller person that can wear multiple hats. The family office industry is famous for trying to find someone who could be hired as a CFO for someone, but maybe they have a little bit of a legal background, might have their law degree, can help you look at contracts as well
Sure.
as the finances and help you with due diligence and sophisticated questions. Maybe they've been responsible for allocating investment dollars before. And typically, it has to be someone who's worn multiple hats, and ideally is someone that's strong in either finance, legal, financial modeling, or the niche industry where you're going to be managing that type of due diligence in-house. That's typically the best first hire that we see. And sometimes it's hard to find that talent. But what people mess up is getting the values figured out first and what they really want, I think.
Sure. What budget should people be thinking about if they're actually going to go through with this? What's the
We've
range?
helped. We recently brought somebody on with 18 years experience and hired another person with about 20 years experience, both in real estate, both credit, deep due diligence operations, et cetera. And I would say the market for somebody like that, like right down the middle, is probably 175 base plus some bonus or incentive. And typically, if they're really helping and going deep on something, you'd give them a little bit of a carry for it going well if they're still here once the project's gone full cycle. If you already have things in progress, they don't get tagged to that, or they just get a little tag on it. Maybe it's super early and you just close last quarter, so you do want them caring about it a ton. But that's kind of the market we see for it. And then some people get paid $1 million a year to work for a family office. But I would say that like kind of the range for somebody with that level of experience starts about where I mentioned.
Yeah. Well, thank you for taking the time out of your day. It's been great kind of up in investments in the opaque world of family offices. So really appreciate it. Well, yeah, where can people learn more about you and your business?
Sure. Yeah. To learn more about Family Office Club, you can go to familyoffices.com or to shoot me an email. It's just richard@familyoffices.com. And we're happy to have you to one of our events as our guest. If you'd like to check it out, we've got a 850 person event coming up next month, and we'll have 125 speakers on stage over 3 days. So if you'd like to come check it out, feel free to just let me know. We'll put you on the list.
Awesome. Well, thanks, Richard.
Thanks, Red.
Take care.